Hey everybody, hope you're doing great today. In this video, I'm going to discuss why low interest rates are bad for the economy. Now, when I'm referring to interest rates, I'm referring in general to the federal funds rate. So here at Investopedia, we can see they define federal funds rate. Federal funds rate refers to the target interest rate set by the Federal Open Market Committee. This target is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. They meet 8 times a year to set a target federal funds rate, which is part of monetary policy. The federal funds rate can influence short-term rates on consumer loans and credit cards. So as the federal fund rate goes up, the interest that you pay on credit cards, the interest that you'll pay on consumer loans for cars, furniture, and whatnot, those go up as well. One positive of having a higher federal funds rate is that the amount of interest you get paid on your savings account, on CDs, and on treasury bills also goes up. So by having an overall low federal funds rate, you are actually introducing inefficiencies into the economy. Basically, by inefficiencies, I mean when rates are low, then in order to earn a rate of return, investors, whether they be pension funds, individuals, corporations, when they're looking to invest their money, they're going to look for other sources in order to earn that interest on any cash that they have sitting there, especially with regards to retirees, those who live on fixed income. They rely a lot on their cash, earning them interest. That interest serves as their income that helps support them throughout their retirement years. And as the rates are low, that forces them to look elsewhere for yield. So we've seen a lot of investors looking at real estate, investing with hedge funds in order to increase their yield. Pension funds, especially insurance companies, they need to earn enough interest to cover their outflows from retirees that they're paying under pension plans. Insurance companies need to earn enough return to cover their payouts for claims, as well as the increase in inflation. So as we can see from this graph, this is the federal funds effective rate history. This goes back to 1955, 1954, when they started keeping track of these numbers. And as you can see, after the 2009 recession, rates were held low for quite some time. They started to go up, and then just pre-COVID, they were also dropped quite a bit, back down close to zero level. And then recently, they have been going up quite a bit. Currently, where we have it at 4.58%, and it's rumored to be going higher, depending on how inflation numbers turn out. So let's talk about the interest rate, the federal funds interest rate, and inflation. How does that impact one on the other? In this chart, I've layered side by side the federal funds effective rate, which is the line in red, alongside the consumer price index, which is the blue line. So as you can see, going back to the 1960s when we started keeping track of the consumer price index, the CPI, as interest rates go down, then you have a tendency to see a spike in inflation. So here, interest rates in 1967 were a little low, and then over the preceding next few years, not only did inflation go up, but in order to control that inflation, the Federal Reserve increased interest rates as well. So these track pretty closely. You'll see another low here in 1973. So both of these track pretty closely. So the higher interest rates do have an impact on inflation. As the interest rates are up, they have a tendency to force consumer prices down. We had some extreme spikes here in the case of the 1980s, and that's because we had inflation that popped up and then dipped back down, but then it came back up again. Some economists are suggesting our current inflation pattern today, here in 2023, are following the same pattern as was in 1980. So as you can see here, once we exited the recession in the 2009, rates were pulled down, and then inflation started ticking up again. And while the CPI and the federal funds rate came pretty close over here, in 2019, the Federal Reserve decided to reduce the interest rates, and while inflation did go down a tad, it then quickly spiked up. So low interest rates do drive inflation. It becomes easier to borrow, it becomes cheaper to borrow when the interest rates are low. That allows more of that money to get put towards risk. As I mentioned before, low interest rates forces people to look for riskier investments so they can get a better rate of return on their dollars. Especially when rates are low, you don't have to worry about the interest cost. It's easier to borrow money. It's cheaper to borrow money. That allows you to engage in more risky endeavors. So certain companies like Carvana, Airbnb, real estate investing companies, Uber, Lyft, those kind of companies, they can operate strictly by borrowing money. They don't necessarily need to gain a profit because money is so cheap. Investors are willing to throw cash at them in hopes of a good return down the line. Then their profitability is not really in consideration. As the interest rates are higher, that forces companies to compete for money. They do need to provide a return to their investors. Otherwise, the investors have other options such as treasury bills, certificates of deposit, CDs from banks, and just parking their money in savings accounts, now of which are offering interest rates in the 3 to 4% depending on the bank. Here's an article from fee.org discussing the Cantillon effect. Headline is, because of inflation, we're financing the financiers, not to mention actively harming the living standards of low-income earners. They discuss inflation as a policy tool. You might have heard the term multiplier effect, which they refer to here. Multiplier effect refers to the money that the government is spending, fiscal policy in terms of interest rate, and how that impacts the economy, gets the economy flowing and running. So the Cantillon effect refers to basically where new money is getting into the economy. With new money that's injected in the economy, those usually the best to take advantage of it do take advantage of it, and that hurts others who don't get access to that money. As it notes here, in other words, the first sectors to receive the newly created money enjoy higher profits as their pay increases, but the general costs are still low. They provide an example here. Fed decides to lower interest rates. Soon after the Fed makes its announcements, investors anticipate new earnings from increased investment. They expect prices to rise, so they get in on the action for buying stocks, buying investments before others can do so, and they reap enormous profits once the prices do rise. So therefore, stockholders are going to see the most benefit from new money being put into the economy compared to those who are on the other end of the scale. Here's another article from the University of Chicago Booth School of Business, titled How Low Interest Rates Can Hurt Competition and the Economy. They help big companies more than small ones, depressing investment and productivity. So basically, low interest rate encourages large companies to expand. While smaller companies do try and expand, the larger companies have a better scale. They're able to do it better. Low interest rates make it cheaper for them to borrow. Being as big as they are, they have better access to the money compared to smaller companies, and they expand and engage in monopolistic behavior. Basically, a lot of these companies are able to consolidate. With the low rates, they can buy out their smaller competitors, or they can just outcompete them, and that results in lower productivity and stagnation in the economy. The article notes here, productivity growth has stagnated or declined throughout the advanced world, so it's not just a local US phenomenon, it's affecting the entire world. End result, consumer loses because there's less competition. The bigger fish keep getting bigger, they consume the smaller fish, or the smaller fish are forced to leave, and as a result, there's less competition, the prices go up, inflation goes up. In this graph here, this shows the total financial assets held by the different categories of wealth percentiles. So we're looking at financial assets. As you can see, the bottom 50% own very few financial assets, whereas the 50 to 90th own a decent amount, but the largest percentage of wealth assets is owned by those in the 90th to top 1 percentile. And during that period when rates were extremely low, the stock market went up. There was a lot of free money being tossed around. Financial assets increased quite a bit. And as you can see, there's quite a bit of gain in the terms of financial assets that the 90% and 1% own. Low interest rates benefited the very rich, but did not benefit the bottom 50%. A more equal economy where everybody participates in the wealth generation is beneficial for everybody. Basically, by floating all boats, everybody enjoys a better standard of living compared to just a few at the top. Low interest rates also encourage more fraud, more crime, because with low interest rates, investors are looking to increase their yield. They want to get more money, so they become more susceptible to fly-by-night schemes, get-rich-quick schemes. These wealth coaches, real estate coaches who are pitching great returns on real estate investments, stock investments, whatnot. Most of these coaches themselves are just interested in making a quick buck off these courses. They might not necessarily have the track record to prove that they're successful investing in real estate, stocks, whatnot, but that doesn't stop people from getting suckered in because interest rates are low on T-bills, interest rates are low on savings accounts, so they need to earn some interest somewhere, versus during a higher interest rate environment where there are safe investments like treasury bills, which are now yielding around 5%, and CDs, which are also in the 4 to 5% range. You can make an investment in there, get very low risk, and get a decent rate of return. So in my opinion, low interest rates are bad for the economy. They encourage risky behavior. They encourage companies to go out and invest in strategies that are not profit-making. We want businesses that make a profit. That profit can then benefit shareholders. It can benefit the employees. It contributes to the overall productivity of the economy. There is a line of thinking that interest rates in general should be set by market forces versus an independent body like the Federal Reserve. Market forces are more likely to balance out the needs of the economy. If there's high demand for money, the interest rate would go up. When the demand is low for whatever reason, whether it be a recession, some other economic malaise, those interest rates can come down based on market demand. What are your thoughts? Do you think the interest rates that banks charge each other should be set by the market or set by a committee on the Federal Reserve? Thank you for watching, and I will see you in the next video.